Well, I'm Ron Sweet. I've been at UTSA for 25 years. I retired from USAA in 2009. So I was teaching and working there at the same time. Retired in '09. I was head of equities, so that's an investment topic, right? Stock markets. So there's our class. So we're going to have 2 exams and 4 papers. So another complaint I get from students is there's not enough stuff with grades on it. So sorry. I'd rather do a few big things than have 50 really small projects. It's just my preference. The papers are all very, very real life papers, something you would actually do in a first job. So, and if any of y'all say I can't write, you either need to learn to write well or change me, because we write a lot in finance. It's just amazing. When I was leaving USAA, I went out and got all the papers I'd written. And I was showing the guy taking my place. And I'm looking back at that history and think, man, this is amazing. This radically changed the company over in all these years. And here are these papers. And this new person could come in and see all of our logic, why we did it, how we did it, why we were proposing certain things related to taxes or risk or whatever. So you've got to get used to writing. I do have some international students that English is a second language. They blow me away. I can't imagine taking a college class, and some of them have been learning English in the last 3 years. I had one student from China, and English is a second language. So he'd bring me his papers before he went to his tutor. And I tell him, this is already the best paper in the class. I think you're okay. Just blows me away because I'm learning Spanish and I couldn't write. I can't write children's stories in Spanish, much less. So it impresses me, but if that's an issue, come talk to me and I'll help you with the grammar and those kind of things, because I have understanding. I had one student struggle a little bit with that. She wrote really good papers, but struggled a little bit because English was second language. And she wanted to put a LinkedIn. So after the semester, she came to me. We went through in detail and fixed everything. So she could put it out. It was all her thoughts, but we just fixed the grammar. So you do going to put paper out there with make it look professional and have it read as well as possible. So we'll get some practice there. If you're not good at writing papers, then get used to it. Class participation and attendance, we'll see how I'm going to handle that. As far as I have in the past, before COVID, I was doing teams. We'll see if we do that here. I really like doing the team aspect. A lot of students said they really like it. We do exam questions in advance so you can practice and you do it as a team and makes it competitive and you get extra points. So we'll see if we can work that out again. I do take attendance, and attendance does affect a grade. Why do I do that? One professor complained and said, Ron, we're not their, she said, I'm not their mother. I'm thinking she doesn't understand why I take attendance. I'm not taking attendance because I'm trying to micromanage your life. I'm taking attendance because this is a horrible thing for me to say, but I'm going to say it. I do not like unengaged students. I don't like students who don't care. They're only going to class to get a degree. They don't want to learn anything. I want those students to drop my class. And what I've discovered is if I count attendance, those students tend to avoid my classes. All right. None of y'all are those type of students, right? I mean, sometimes I'll look up during a really exciting topic and I see someone who looks bored to tears. It's like, okay, you're 22 and a finance major and you're already bored with your major. That depresses the life out of me. There's nothing we're going to talk about in this class that is not, to me, just amazingly important and interesting. So this is your career, right? You're going to be doing this for the next 50 years or maybe next 3 years, and then you'll switch to finance, but you're going to be doing this the next 50 years of your life, or for me, 20 years, right? I retired kind of early, but you better love it. I can tell you, if I didn't love finance in 2008, I think I would have just dropped dead, because that was a horrible year. I was running equities, running a stock portfolio. We didn't sleep much. I remember the doctor I used, he had a lot of people in my area, and I went and saw him that November. He's like, what's going on with you guys? Your blood pressure is off the charts, your pulse rates, what's going on? So yeah, this is really tough. It's a horrible year. And I retired in '09, so I retired after all of that. So yeah, it's tough. You better love it, because finance is intense, it's stressful, it's exciting. You're dealing with big numbers. I remember the first time I picked up the phone and traded $1 billion. That doesn't sound like much today when you have these $10 trillion companies, but still you pick up the phone and move $1 billion. It's, you're like, wait, let me make sure I did that right. Wait, did I say buy or did I say sell? Wait, let me call you back. You're like, make sure I got that right. So I only want engaged students that really care. So if you don't care, you're not interested, you're just getting a degree because accounting was too hard, or you couldn't decide, or you flipped a coin, then find another professor. You're not going to do well in this class. I have a high school kid who wants to meet with me once a week. He's a junior in high school and he wants to get a head start on finance. That's how excited he is. I was like, sure, if you want to do that. All right, so attendance, I will count attendance. If you're going to miss more than 20-30% of the semester, just drop now. I do record all the classes. They are on Zoom. I put them on my YouTube channel, but that's backup. That's not the class. You need to be here, participate, ask questions. So the Zoom is there. If you have something happen, obviously if you're sick, don't come, or you have some family emergency, you can watch it on Zoom, submit your notes, and I'll give you attendance credit for a few classes, not for every class. I've had students catch me the last week of school and say, hey, I missed all your classes, but I had this issue and I knew you'd understand. Like, no, those conversations you have the first week of class, not the last week of class. So you need to come to class, participate. And then if you do the instructor survey, I throw in 1% on your grade just for doing the survey, because I do look at those and read them. I usually get great professor, love the professor, great professor, poor professor, avoid him at all costs. Those are usually my comments. So I'm either the best or the worst. No one likes me. They either love me or hate me. I don't know how to fix that. Especially because the ones that hate me don't tell me why. They just have all these comments I can't really up. So if something's messing up with you with this class, let me know. I can make changes or find ways to help you or give you resources that you can go to. Any questions on this? We're going to exam 1 is a very, very unusual exam. Very, very unusual exam. We're going to be spending the next several weeks on that exam question. Very open-ended question. I'm going to give you a template to answer it. Very, very, very detailed. I like the template. I think it works really, really well. I've had students, I think the funniest thing was students in this class right after the exam got interviewed by USAA, and USA asked them the exam question without even knowing it was the exam question. And the lady comes out, I knew her from USAA. She's like, wow, that's like the smartest group of students I've ever had. She said she was taking notes, not because of the interviews. She was taking notes because she was going to go home and change her portfolio. She was just blown away. And I said, yeah, that's kind of cheating because they just studied this massive question and they're ready for that question. But it is a very popular question in interviews. So I'm going to give you what I think is a very, very good answer. It's a very conventional answer. So I'll give you some hints where finance may be changing and thinking differently about it. A pretty intense essay question. There's 2 questions. One's a very open-ended essay question. The second one is the application. You're going to take everything you did on the first question. I'm going to give you a scenario and you're going to respond to that scenario. All right, so we'll walk through that. Plenty of practice. I'm going to give you all kinds of things that help you remember. And then the first paper. So if you go out to Blackboard and you go under content, you have paper descriptions. So you can see paper 1. We'll talk a little bit about it, but let me just show you an example paper. Here's one from last semester. This format look familiar? I started using this format. Does that look professional to you? Does that look like a student paper? How many of y'all be ashamed to have your name on that paper? Just looking at it. Does it look pretty good? So I started using this format. The student who first did this, I saw him this summer. And I said, hey, Jay, your paper has changed finance at UTSA because everybody's using this format. Have y'all seen this format at UTSA yet? So it may come out of my class. I've had other professors, they don't like this format because of the 2 columns. But what he did when he did this format, he went to the Financial Analyst Journal, very professional journal, and he looked at exactly how they had it lined up and used that format. How can you tell a student paper? One column, wide margins, double space. Don't ever double space the rest of your entire life. Why do students do double space? More pages. I don't grade on number of pages. In fact, I might count off if you have too many pages. You got to be succinct and get to the point. But double space, doesn't that look unprofessional? You want that on LinkedIn? You want that on LinkedIn? You know, think you're in the optometrist's office. Do you want that or that? Which looks better to you? Which do you want your name on? So I use this format. I don't count off if you don't use the format, but man, you don't want to put a double space college paper. You don't want it to look like a college paper. So from the rest of your career in college, everything you produce should look like a professional document you do on the job. All right. So I like this. You have an abstract up front, good use of titles, full justified. I like full justified, thin margins, double column, good use of graphics throughout. Yeah, just really, really good stuff. Now, the key is, did he actually say something of value? That we'll have to get into that as we read through some of these. This paper is an example paper. It won't help you because you're writing a different report on the same information, but at, very different numbers. But very impressive. He actually shared this, and I asked some of y'all to do this. He actually shared this with the class report was due, and I actually graded it in class. And then he made edits and resubmitted it. And he kind of intimidated class because his first draft wasn't far off of this. But he'd been in the business for several years and had some background, so he was ready to go for it. But I've had, there's other papers out there that look very, very professional as well. I've given you a few. I don't know, having more than one is really going to help you. Go down and look. I put all my financial analyst journals down in the FSC. Go look at one and just see what it looks like. Try to get that to look as good as possible. I teach a security analysis class at 7:30. And their final report, they don't want it to look like this. They want it to look like a sell-side analyst report. So they're going to JP Morgan and Deutsche and those kind of entities, and they're looking. So it's a little bit different format. It's still 2 columns and all that kind of stuff, but what they put in and how they do they make it look almost like it's a published report from JP Morgan as much as they can. This is more of a research report on that you give, like could go corporate finance, could go investing. It's just you want to communicate with your boss. But we'll talk through this as we get into it. So make it as professional as you possibly can. Everything you do from now on out should just be as professional as possible. So you have 4 papers. The first one's on economics, the payroll report, which is pretty important. I don't think this is the last one before the election, but I think it's the second to last one before the election. Do you think Biden's interested in this next report? He got a great one, this last one. But you don't get the great one right when you want it. You get it 3 months early. What do the voters think about? They're very influenced by the latest one. You can say, well, the previous 4 are really good. Say, no, but this last one is really horrible. So voters have a very short memory. Obviously, they're going to be looking at the payroll inflation. That's going to be a big deal. So we'll look at it today. We'll look at the last report, and then next Friday, you can look at the new report. The second paper is a earnings report. If you've never done an earnings report, we're going to practice doing one of those so you get used to doing that type of analysis. Pretty straightforward one. And then the last 2 papers are really one paper, but we're going to combine 2 papers into one, and that's the evaluation paper. Really good practice. In fact, my security analysis class does the exact same paper as part of a much bigger paper. So some of them have taken my class. They can actually just take that paper and reuse it. And I don't count off for plagiarism if you plagiarize yourself. You can plagiarize yourself. So it's if you take my security analysis class, it gives you a little bit of an advantage in there. All right, any questions on any of that? You can see the description of the papers here. We're going to be spending the first, I say paper 1 preparation here. We may wait and see. Probably more The report comes out the first Friday, so it should come out September 2nd. And so I'll help prep you. So that paper one preparation actually is going to be spread out over a few days. And then we'll actually have, before paper one's due, I'll find someone in the class that will send me their draft, and I'll actually grade their draft in class. So you can see exactly how I grade. So you don't have any questions on that, all right? So here's exam one. All of this to get ready for exam one. So we'll be spending quite a few weeks there. And then the rest of the class, the second exam is more of a normal exam, a lot of math, short answers. So it's a more normal exam. The first exam is not a normal exam at all. Some students completely bomb the exam because they're so used to multiple choice. You study for this exam like you study for multiple choice, it's not going to work. It's going to be a disaster. So you've got to just learn it. I always tell students, in fact, you ask some of my students, my most famous sayings, one of them is, don't memorize it, just know it. Don't bother. If you're memorizing it, short-term memory, you're wasting your time. Learn it permanently, forever and ever. Just know it. This is the stuff you should know as a finance major. You know, if I were to list the 1,000 things you need to know graduating from college with a finance degree, we're going to cover a bunch of them in this class. Stuff that you just know off the top of your head. You don't have to think about it. Don't tell your boss, well, I can go Google that. That's not where they're hiring. They're not hiring you to go Google stuff. They're hiring you, they give you something you can sit down, you can do it off the top of your head without having to look anything up. So we got to get to that point where this stuff becomes second nature to you. All right, and we will finish up with derivatives. Maybe I can get Eric come talk to this class on Zoom. I saw Eric in Chicago. He's working for Chicago Board of Options Exchange. He's a big options trader. Pretty exciting job. Or if any of you are interested in that as a career, I might be able to hook you up with him to talk to him. We use options a lot at UTSA. I'm a big believer in options. So we'll definitely finish up with those. And I will mention, students come by and talk to me or call me to talk careers. Anytime you want to talk careers, come talk to me. I'll do that. So do you want to do corporate finance, or do you want to do investing, or do you want to do investment banking, or do you want wealth management? I have strong opinions on every single one of those. If you're interested in wealth management, I may talk you out of it. I'm not a big fan of wealth management, but at the same time, I may talk you into it. I may say, hey, given what you're saying, I can see you would work well in that environment. It's not something I would want to do, but you might want to. I teach a security analysis class. I don't want to be a security analyst. I didn't enjoy that. I'm a balance sheet immunizer. I love that. I was really, really good at that. I learned it backwards and forwards at UTSA. I love that part of finance. Security analysts just didn't. I like it. It's enjoyable, but it's not nearly as exciting as the balance sheet immunization. If you're uncertain, which might be all of y'all, I remember when I was where you are, I had no clue what I wanted to do. I got an accounting major just because I was a music major, finished my music major, and I'm thinking I'm not gonna make much money doing this because I wasn't all that good a musician. And I told my French horn playing friend, I go, can't figure out what I want to do. I was thinking either accounting or computer science. And she said, don't do accounting. My roommate's an accounting major, and she says it's really hard. And that was my entire thought process. I became an accounting major 10 minutes later, just because she said that. I knew nothing about accounting. My first accounting class was like debit and credit. What are we talking about? What is this? But, so I was clueless. You don't want to be clueless. And, I have some students, I'll talk to them, and they'll say, yeah, that's what I want to do. Well, that's great. That's what you want to do. But if they don't offer you that job, you're not going to be doing that. You're not going to be doing any job you don't get offered. Do you all agree with that? So you might say you want to do investment banking, but if you don't get offered a job in investment banking, you're not going to be doing investment banking, at least not initially, which is perfectly fine. Corporate finance is a great avenue into almost all of finance. So there are a lot of corporate finance jobs. I actually think if you don't have a clue what you want to do, go to corporate finance. Start there. 2 or 3 years later, you'll have a pretty good idea what you want to do next. So I started in corporate finance and ended up in investing. I know a lot of people who do that. It works really hard. We're actually starting accounting, then with the finance, corporate finance, and then with the investing. It can work. We've had several students start in investment banking and have done extremely, extremely well. I don't like that lifestyle. It just, to me, I don't working late hours like that every single day. Although I had a few years of that at USA, but not where everybody's, stabbing you in the back. They're trying to get your job. They want you to fail. So I don't like that environment. So it's just not my personality, but some students, that's the way they are. They're very competitive. It's like, yeah, I'm going to go in and I'm going to take over the world. Yeah, that can work. Wealth management. Boy, once you've explained what a mutual fund is the 1000th time to people who know nothing about finance, it gets really old. But I have other students say, I really want to help people. So it kind of depends what you want to do. I want to radically change companies. That was my thing. So I didn't know I had that in my ego. It's like, I want to radically change this company. I couldn't do it in accounting. I could do it in finance. I remember in accounting, my boss was sick, so I had to do her presentation. And so I'll go up there and present and I'll say, our annuity revenues were up 5% because we sold more annuities. And they're like, wait, great insight. Thank you very much. And I started thinking, well, how do we sell more annuities? What can we do with them? How can we invest better to get better? And I was like, I want to be on the side that's actually changing the company, not on the side that's reporting about the change in the company. But some people, different personalities. So if you have any questions about career, I'm on a bike 5 hours every morning. You call me, I'll talk to you as long as you need. I may be out of breath. There's one hill that's really steep that I do. So if you call me right then, you might think I'm about to die, but just let me get to the top of the hill, I'll be fine. But if you're sitting there like I was at your age, just panicking, like I don't have a clue what I want to do, then call me. I can at least talk you through the different options. One thing I've discovered with a lot of students is they panic because they don't have the next 50 years planned out. And that's a little bit much. All you need to do is get the next step. So what do you need to do? You need to make sure you're interviewing this semester. This is a really critical semester, this fall semester. That's when firms are interviewing. Do y'all have interns set up for next summer or permanent jobs for next summer? This is the semester to do it. You need to be involved in a student organization. There's several of them out there. I do the investment society, but there's other ones out there that you can join. You need to be involved there, get a leadership role. This is the semester to really beef up that resume. So, start doing that and start interviewing. It's all volume. Firms are hiring a lot of finance majors, so it's not a bad time to be looking for a job. But there's certain things they're looking for. The number one thing is curiosity. They want to know that you find finance interesting. You're already bored with finance, so they're not going to be interested in this. They want you to come in and really gung ho. And the stuff we're going to do in this class is going to help you because it's going to give you some of those catchphrases. If you go interview on a job the day the employment report comes out, you're going to remember paper one. You're going to be able to say really intelligent things about it. Or if an earnings report just came out, you would have done paper two and you'll be able to intelligently talk about that kind of thing. So it gives you those things that you can show you're really curious. But firms today are coming out of 2008. They're really worried about unengaged students. They want students that are involved in organizations. Volunteering is actually really, really good to do. I don't know what groups there are here to do volunteer type of work, but anything you can do that just beefs up that resume just shows that you're doing stuff outside of class. But feel free to call me. I can help you through. I have my last blog, actually, I wrote my last blog, How to Be Successful as a College Student. So you can get all my ideas there. So, all right. Questions on the syllabus? All right, let's talk paper one. You can't do too much on paper one yet, but let's at least look at what it is so you can start thinking about it. So I have like 18 hours of economics. So I'm not an economist, but finance, we know economics. We just have to. Like finance majors should know economics, should know accounting. I know some finance majors that became finance majors because accounting was too hard, but you can't do that. You have to know accounting better than the accounting majors being finance. But economics, you've got to know economics. It's pretty hilarious at USA. We had a chief economist and he quit because he didn't have enough to do. So my boss calls me and says, they want to give you all of his responsibilities. I says, yeah, sure, bring it on. So they gave me all this, and I said, you realize I only have 18 hours of economics. But they made me their chief economist. They didn't give me the title, but I was making economic presentations every planning conference. And I kept thinking, you know, I don't know what I'm talking about, but yeah, sure, I'll do it. I enjoyed it. It was a lot of fun. It was kind of interesting. The president of our life insurance company, I saw her several years later, and she was introducing me to her staff, and she introduced me as USA's chief economist. It's like, wow, that's really wild. That's what she remembers about me. So you've got to know economics. What that means is you need to be reading economics all the time. So find a website that reports economic data and just start reading what they're reporting. Which ones are important? Which ones aren't that important? Some of them are real important at certain times and then ignore the rest of the time. Some of them are almost never important except for certain industries. So it just depends. But there is one report that the market always pays attention to. And what report is that? Payroll. The jobs report. That's the one report that everybody's going to read about. It doesn't always move markets. I'm hoping we get a crazy report next week. Hope markets just go absolutely wild, but we'll see. We've had a few. I've had some that were really, really boring. And the poor students are trying, how do I write a paper? Nothing really happened. And so you got to do your best. Some of them went a little overboard and wrote this really exciting paper about something really that wasn't all that exciting, but they really wanted to sink into it. So do you follow the payroll report? How many of y'all have never read the payroll report once in your entire life? Is that the majority of the classroom? All right, that's the last time you're going to say that. And I don't mean because you're going to look at it next Friday because of this class. I mean next Friday, and guess when's the next time you're going to look at it? The next month, and then the next month. For the rest of your life, you're going to get up on the first Friday of the month, and you're going to be looking for that employment report. If you have a job interview on a Friday, first Friday of the month, and you didn't do that, you're in a lot of trouble. The first thing they're going to ask you, what did you think about that jobs report? And then you're going to be trying to do the fake jobs. Oh, yeah, that was really interesting, wasn't it? What did you think? That's not going to get you the job. You need to come in and say, wow, I can't believe that was a really strong number, but boy, that inflation number is kind of scary. I was amazed the markets didn't react more negative. You know, that's what they're listening for. That's that curiosity piece, right? You're interested in markets, so you're looking to a report and you can talk intelligently about it. Really, really important. So I'm trying to get you in the habit, not just for this paper, for the rest of your life, looking at that report. Now that I'm retired, there's a few Fridays I just completely forget about it. And then Friday afternoon, it's like, oh, wait, the jobs report came out. How did it come out? And so I'm looking for articles. But boy, during my career, I'm sitting there on my computer hitting refresh. Where is it? Very, very interested in the numbers, and then interested in how the market interprets the numbers. So you're going to write your report on that. You can add other numbers. We'll talk about this more. The ISM manufacturing report comes out the same week on the Wednesday. Sometimes the market completely ignores that report. This is a report that's important when it surprises. It may be important this next month because right now everybody's worried about a recession. And the ISM is one of the best predictors of a recession. It's been really, really strong the last few months. So there's not a real strong indication that we're in recession. If that thing flips from 52 to 48, it could move markets. Jobless claims comes out on a Thursday before. Jobless claim comes out every week. So it's a weekly number. It comes out the day before. So real clear on this paper, your boss is asking you to write about the jobs report. She's not asking you to write about ISM. She's not asking about the jobless claims. So if you put those into your paper, that's perfectly good. You just got to explain why you're putting that into your paper. So you might say something like, in addition to jobs report, it's interesting, ISM came out 2 days earlier, blah, 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 supports the jobs report. It seems to contradict it. You got to set up why you're talking about that. Okay, so we'll talk that. What And we won't know what you're going to put into your report until we see. If the jobless claims numbers didn't do anything, pretty boring, then there's no reason to bring that. Don't force things into your paper that don't add insight into that number. But if there's other things that happen that week that you think really help you, that can be added to your report. So what are you going to do? How did it come out versus expected? So this last month, what happened? New jobs materially beat expectations, which is pretty good. If everybody's worried about a recession, you're probably not having a recession if people are hiring a lot of people. I don't know if y'all use the JOLT report. The JOLT report's been really interesting. That's the number of people that are switching jobs, jumping around. That one's been really interesting. People don't usually quit a job to go to another job if we're going in recession, right? You cling on with both fists to that job you have. So there's interesting things going. So the job side of our market, our economy, is not hinting at any recession whatsoever. Things look really strong. That's why the market loves the jobless claims, because the jobless claims comes out every week, and it's kind of that first warning sign that there may be trouble. But the jobs report's very timely. It comes out that first Friday for the previous month. So it's a very timely report. A few years ago, the Bureau of Labor called me and said, we have this survey for employment. We're wondering if you can make you part of that survey. And go, of course. It's like, this is cool. I get to be part of the survey. So I'm one of those, thousands of Americans that they put into the survey. I found it really interesting. Boy, they're very strict. They're not going to give up on you until you answer their questions. This isn't something like, well, I couldn't catch 10% of them. No, they have to go and find every single person. And they ask me questions like, were you working last week? And I would say, yes, I was professor teaching, or in the summer, got really confusing. It's like, well, I didn't work last week because I'm on summer vacation. And then they asked me, did you want to work last week? Well, I don't know. I didn't really want to work last week. I like working, I didn't know how to answer. So I probably messed up their whole report because I didn't really know exactly how to answer that. But what they want to know is, did you work last week? If you didn't work last week, did you want to work last week? If you didn't work last week and you didn't want to work last week, you're not unemployed. If you didn't work last week and you wanted to work last week, then you're unemployed. If you worked last week, then obviously you wanted to work last week, so then you're employed. So that's really critical. And you're going to see that when you look at something called the participation rate. So the participation rate is how many people want to be employed in our economy. Because we know baby boomers, they're all retiring, right? I'm a baby boomer, just barely. I just got in on the line. I think I was born in the last year of baby boomers. We're starting to retire. So we're not unemployed. We chose not to work. We had some interesting numbers. In a recession, you can get some interesting numbers because some people are worried about their jobs, so they quit and go back to college. And they're not unemployed because they chose to go to college. So the numbers there's some strange things that can come in through the numbers. I'm hoping we get some wacky numbers. So you want to look and see, how do these numbers come out? You got to know how many numbers there are. There's the jobs, which is usually the most important number. There's an unemployment rate, which is what most retail people look at. Finance looks at the jobs, but most of retail is in fact, you can see, if you go to Bloomberg, the headlines usually has the jobs. If you go to CNN, they usually have the unemployment rate, because it's just two different groups of people. I was part of the unemployment report. So they called me to ask me that. The jobs number, they interview corporations. That's how many jobs did you add? How many people did you hire? So you have the participation rate, you got the inflation numbers that can be really important. You got the number of hours worked. There's a lot of things going on in these numbers. Some of them are incredibly unimportant, and you just ignore them. One thing that I think is really helpful to do is actually go find out what industry was causing these numbers to move. So we have to go, I can't remember from last month, but 500 and something thousand jobs were added. Was there any one industry that really drove that? We know people are flying a lot. Restaurants are crazy, aren't they, right now? My word, they're packed full of restaurants. People are so sick and tired of cooking for themselves for 2 years. And so now they're all out eating. That's good. More people are being hired, and then what are restaurants finding? They can't find anybody to hire. No one wants to work in that industry, so it's creating some strange reactions. So what industries are hiring? What industries are laying off? Housing starting to show some weaknesses. I just sold my mom's house a few months ago. I'm kind of glad I did. She's in assisted living now. She bought the house for 160. We sold it for 540. That is her retirement plan, is that house and her son. That's what she's got for the rest of her life. I'm going to take good care of her, but I'm glad she had that house, so I don't have to do that much. But boy, I don't know if she could sell that house for 540 today with mortgage rates coming up and everything else. It was in Austin. Austin's still a pretty hot market. All right, so let's look at a previous report just out of the fun of it. So the last report came out August 5th, the first Friday of the month. There's the unemployment rate. It came in at 3.5. The consensus was 3.6. They expected to stay the same, 3.6. Came in at 3.5. It sounds pretty good, doesn't it? Is 3.5 a low rate or a high rate? What would you think? Pretty low rate. How would you know that? So the one thing you really got to get into your arsenal is, I tell students, you got to know when the gas. When is a number crazy? When is it normal? So if I were you, I'd go out and get all the historical unemployment rates for all of history and just look and see where they are. What's a high number? What's a low number? So we're at historically very, very low numbers. Now the theory in economics is low unemployment means what? What does low unemployment cause?
Higher productivity, higher GDP, or like
Can be more productive. What if you get more people hired without productivity? You're gonna get what? Inflation, right? So you got to bring out those productivity. Productivity is a really important number. You don't get that much in this report, but a very, very important number. If we're hiring more people, but they're producing less, that's just going to make us poorer. That's not good. If we're hiring more people, we have 5% more people, but they're producing 7% more. That's good. We're getting more productive. But inflation's a big one here. So we're starting to get to these numbers. We talk about full employment. You're running out of workers, and the only way to get more workers, you got to pay them a whole lot more. That's an issue. But here's the jobs number, 528. Look at that number. They were expecting 250 and they got 528. Is that a good number? What's a normal good number? That's the other thing. I bring that in. Most of my career, we said 300 was a good number. But I think now, because of the baby boomers retiring, they're starting to say 200 is a good number. So 528 is a really good number. Really, really good number. Now you should go back and look at these numbers in March of April of 2020. We've never seen numbers like that before in the history of economics. It's pretty funny. Bloomberg has some really great eco charts, and up through 2019, they all look really nice and pretty. And then you do 2020, and every chart looks like a straight line with 2020, because it's just off the charts. The jobless claims used to be jobless claims. I don't know, 500,000 was a really high number, and we suddenly had like 11 million in 1 month. You can't even draw it on the charts. So that is a very strong number, 528. So 200 might be normal. There's a participation rate. You can see participation actually dropped some. That's usually not a good sign. And that may be why the unemployment rate dropped. If people said, I was looking for a job and I'm not looking anymore, that's going to cause the unemployment rate to come down, because we're not counting them. That may not be a good reason for the rate to come down. So you have to somewhat size that up. Now, what is this number? Is this a high or low number historically? Anybody know? We have low participation, average, or high? So this is something you can definitely write about. That number is unusually low. It dropped a bunch after COVID, but it's been dropping for quite some time. So it's unusually low. Is it because of baby boomers? Is it because more people are going back to college? Who knows? But it's a historically low number. It jumped in the 70s. We'll talk some about this. As more and more women join the workforce. And now we're seeing people leave. So what's a good number? Average earnings, pretty high numbers. So we are definitely seeing inflation. So 5%. Now we're seeing 8% inflation, but pay's going up 5%. How long will workers let you get away with that? That's not too good, is it? It's like, hey, it's cost me 8% more to eat and drive my car, and you're only paying me 5% more. So I'm actually, my standard of living is coming down. So that's a really, really important number. They show manufacturing payrolls, but I wouldn't use that number. I would actually go on and see that was only 30,000. So that's obviously not what's driving this number. So I want to go in and see which of those numbers is being driven the most. The Department of Labor puts this report out. If you go to the Department of Labor's website, it's a really boring 10-page report, but that's what you do in finance. Sometimes you have to go through that nitty-gritty, and they will give you every detail you can possibly want and exactly why things are moving. So I don't know who writes that. It's not, they don't write it in any way that's really exciting to read, but they write every single thing. So if you want to get into those nitty-gritty details, what are you looking for? You're looking for something really major hidden in all that. So I don't know why that, you may know why the 528, it didn't come from manufacturing. You may know what industry really drove it. I would guess it might be leisure, it might be restaurants and airlines and those type of things, but I don't know. The non-farm private is really, really important because you take those government jobs out. I've seen some reports that look bad, but then when you looked into it, it was government, state governments that were cutting people. So the private payrolls was actually pretty decent, but governments were cutting people. You saw that a lot when 2008 hit. A lot of governments are cutting teachers and anybody that could cut, they were cutting them. And so you saw the government payrolls was a negative number, but the private was positive. So these all come out together. You'll see papers talking about all of these things. You'll have articles. You see, they come out at 7:30. They come out about an hour before the markets open. So markets open at 9:30. This comes out an hour early, but the markets will react even before they open. Y'all know that? Y'all know about the pre-market, the futures, and so you can actually get, and I'll try to get that information for you, where you can actually see what the markets were thinking the second this came out. And you'll usually see a blip where people are reacting to the initial number because they're out in that pre-market. And then when the market opens, that's when you get everybody else, and you may see a big shift. The pre-market might have a different opinion than the post-market. You also have that initial reaction. They're just looking at numbers, but then they got to deep dive in and just see what number is moving. And so, they're reacting real fast immediately, and then they're looking to see, okay, which industries are moving? Do we care about those industries? What's the inflation numbers? What's driving the inflation numbers? They're getting the nitty-gritty. So that's why it's kind of jumps around a bunch the first 5 or 10 minutes until people figure out what's going on. But there's people just sitting there on their computer waiting for that number to come in. And as soon as it comes in, they're plugging numbers into their models, hitting calc, and they're putting trades in really, really fast. So it's really, really important stuff. All right, so this is one website. Here's another website I'm having a lot of trouble with. So this one may not work, and I don't know why it's not working. I think what they do with their website is, if it's the current report, you can get to it through this website. If it's not the current report, you have to pay them money or something. So maybe why they won't let me get into this number. I don't know. Let's see. Let's look at some reports. I don't know if there's any. Well, there's durable goods. That's a pretty important one. See if they'll let me show that one. You can see all these new home sales. That's been pretty important. Existing home sales, new home sales, home prices, median home prices. Those have all been important numbers. So, all right. So you can see this one actually worked. When you click, I like this website because it gives you all the details in one chart. So hopefully we'll see you next Friday. If we can click, we'll get the entire report. I was hoping to be able to show you that here, but they have a report on the payroll where they show everything: the jobs, unemployment rate report, the participation rate, the inflation. They have it all in one big table. So that will make it much, much easier. The other thing you can do if you're a finance major and you don't have a Bloomberg account, you need to get a Bloomberg account. So go down to the FSC on the first floor, get a Bloomberg account. And then once you get logged on, you just type ECO, and they bring up their entire economics thing, and they have all kinds of stuff that you can use. That's really, really cool stuff. All kinds of charts, historical stuff, articles, a lot of stuff that you can do. Well, I wish I could show you the ISM. Let's see if the ISM's in here. So let's look at the last one since I can't remember what a report was. That would have been August. Here it is. Here it is, ISM. You can see how strong it is. Okay, so the ISM, you may or may not put this into your paper. I think it might be important because it is really one of the most important predictors of recessions. So have y'all heard of the leading economic indicators, the LEI? Does that sound familiar? If I were you,
The yield curve and stuff like that?
yield curve's in there, stock market's in there. If I were you, I would go do a Google search on leading economic indicators and see what they are. Because these are economists telling you these are the factors that are most important for predicting a recession. So what are they? And the ISM is one of those numbers. So yield curve is as well a very important one. Right now, the yield curve is saying what? Recession, 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 because it's inverted. But this is not saying recession. So ISM, if it's above 50, that's strength. If it's below 50, that means slowing down. If it's below 43, that means recession. Where are we right now? We're at 56.7. That's a pretty strong number. These are surveys asking purchasing managers, how do things look the next 6 months? So these are people who know what's going on. They're ordering. In fact, new orders is a big part of the ISM. They're ordering stuff. You're not going to be ordering a bunch of stuff if you're not selling. So that's a good one to look at. And then the jobless claims comes out on Thursday. 260, yeah, 200 to 300 is pretty normal. This is the number that jumped to several million all in one week. It was just crazy. All right, so there's the first paper. So what could you do on the first paper right now? You could go back, look at the last report, read some articles, get used to the jargon, start thinking about it, but you really can't do anything until the report comes out. So what I want to do the first part of the next class, we'll spend quite a bit of time on this because I want to make sure you're used to this, is how do you talk about the stock market? First of all, what is the stock market? For most people in finance, it's the S&P 500. It's not the Dow, it's the S&P 500. So you want to know what level it is at, and then you want to be able to talk about how it changed. So the S&P, I'll say it, and then we'll practice more on Thursday. The S&P, well, let's look at the close today. So we'll look at the actual close. Oh, hardly did anything today. That's why it's just so boring. So the S&P was down 9 points, or 0.22% today, closing at 4128.73. All right, it's down 9 points, not 9 basis points, but down 9 points. Why don't I say it's down $9? I don't know why, but we don't say that. Okay, the S&P is not down $9. It's down 9 points, or 0.22%, not 22 basis points. It's down 0.22%. All right, so in your paper, you're going to say the market reacted to the employment part because by being down 20 points or 0.4%, whatever, you're going to talk points and percent, and then give me what the closing amount was. The other one you're going to definitely look at is the 10-year treasury. This is the one students lose the most points on paper 1. So the 10-year bond was down, I'm going to just say it, it was down 1.7 basis points to close at 3.054%. Not points, down 1.7 basis points. Y'all know what a basis point is? 1 basis point is 0.0001 or 0.01%. A basis points is 1/10,000th. Okay. So if I go from 3.21% to 3.2%, I went down 1 basis point. Okay. We'll practice that more. We do not say the 10-year treasury was up. The yield was up. I might have said that wrong. The yield was up 1.7 basis points. So what did the price do? What do bond prices do when interest rates go up? Bond prices fall when interest rates go up. So the 10-year treasury is down. Is that a lot or little? We'll talk about that next class. Is 1.7 basis points a big day or a small day? I'm going to give you a number for both of these that you can take with you for interviews. I'm going to give you 6.5 on the 10-year and 1% for the S&P. 6.5 is a 1 standard deviation event for the 10-year treasury. 6.5 basis points is a 1 standard deviation event. So if interest rates moved, and I'll give you some previous days here, we can see on the 19th, interest rates were up 11 basis points. Was that a big day or a small day? That's a big day. It's almost 2 standard deviations. Was it a good day for bond markets or a bad day for bond markets? Interest rates are up 11 basis points. Really bad day. So you go into an interview and they ask you, hey, what did you think about the employment report? It says, wow, I mean, you see 10-year treasury up 11 basis points. Wow, that's a real sell-off in the bond market. If you instead say, wow, 10-year treasury is up 11 basis points, that's a really great day for bonds. They're going to say, hey, thank you very much for your time. Next. You've got to get, so this is just second nature to you. So, but the other thing you have to know is that 11 is a big day. You come in the interview and say, wow, the 10-year treasury is up 1 basis point today. That's incredible. Like, well, that's no news. Who cares about that? Again, go back to 2020. We had some crazy days in 2020. We're talking 25, 30 basis points in a day. Interest rate moves, just absolutely insane. For the S&P 500, 1% is a 1 standard deviation event. So if you see the S&P move less than 1%, that's fairly normal. It moves more than 1%. So what about yesterday? What kind of market was yesterday?
It was a big move. It was like
Big day.
2%.
2%. That's 2 standard deviations, right? You remember that from statistics, 2 standard deviations. So a 2% day is pretty big. You don't go into an interview and the market's up 2%. You don't know about it. You walk in and say, hey, what do you think about the markets today? Oh, yeah, kind of boring. Boring, it was up 2%. What are you talking about? That was a big day. So they will count off a lot of points for that. If you don't know the obvious stuff that's going on in markets, boy, that's really going to hurt you a lot. So get in the habit. That's the reason we do these papers, so you can start getting the habit of looking at these things, getting used to what they are. So yesterday, the market was down. I don't know how much that is. I didn't give you the change, but 90 points or 2.14%. Today it started up about 0.5%, and then it ended up down for the day. We've had a really good stock rally these last few weeks, couple of weeks. This week's not been so good. What's the market thinking about? Well, that's what you're going to write about in your paper. Is the market worried about recession? Are they worried about inflation? Are they worried about the Fed? Are they worried about Putin? Are they worried about Taiwan? That's why I worry about is Taiwan. What's the market's focused in on? Do you think President Xi is going to attack Taiwan in the next 6 months? What would happen to semiconductor prices if he did? You know, these are big things we have to worry about. You know, the Putin thing, we're kind of getting used to, right? You hardly even notice it in the news anymore. Those are the kind of things that move markets. What's going on with this employment report? Obviously, we have an election coming up. Is the market looking at the election? Does the market want the Republicans to win the Senate, or do they not want the Republicans to win the Senate? Those are the kind of things, you know, you're trying to figure out. Now, you don't get political in your paper. I've had students do that, put all their political beliefs. Your boss, I hate to offend you, but your boss doesn't care. Your boss wants the facts. So we'll talk about that. What do you put in your paper? You're not trying to give some diatribe on whether you like Biden or don't like Biden. Your boss just doesn't care, and could be really bad because they could be on the exact opposite side. So you don't want to do that. But you can say the markets wanted Republicans win because of this tax policy or whatever. You know, Democrats are increasing taxes to corporations. You can make those kind of arguments, But when you make those kind of arguments, you always want to have a quote to support it. So it's not just your opinion, and we'll talk about how to do that. So we'll talk more and we'll practice it. I'm going to call on some of you to tell me what markets did to use it. I'll type it out and then I'll have you respond to exactly how you're supposed to say it in an interview, so you sound like a finance professional and not like a college student. Okay. Any questions on anything? I will use a seating chart. And so wherever you sit on Thursday, you're stuck there the entire rest of the semester. So pick a place you like and see. We'll see who are the front seat people and the back seat people. All right. No questions on anything? I'll let you out a few minutes early.
I'm sorry, I had a question about, just like really quick, so like when they would say like the Federal Reserve raising rates 50 basis points, so that means like as a decimal, like. how
Well,
does that-
we'll talk more on that. Why do we use basis points and not percents? Why don't we say the Fed raised rates 0.5%? Right. So you'll get this on Thursday. If you're talking about something that is not a percent, you talk about its percentage change. If you're talking about something that is a percent, like an interest rate, you don't talk about the percentage change. So we don't talk about the percentage change of the percent. We talk about basis points. So we'll see that. It makes it much more clear what you're talking about. So, all right, I'll see y'all on Thursday. I'll talk about the investment society as we get closer. Our first meeting's a couple weeks out, so I'll let y'all know on that. So here's the S&P today. It's up 0.8%. Is that a huge day? A decent day? Small day? Decent day, because what's our kind of our benchmark? 1% is a one standard deviation event. So one is 70% of the time it's plus or minus 1%. So this is a fairly normal day. It's a positive day. How much did it move? 32 points. The S&P was up 32 points today, or I don't know what it closed at. I haven't looked at it. You notice the volume's down quite a bit, but I did this before the end of the day, so that could change quite a bit. You can see the normal volume. On a big day, you might see a volume that's twice that, 3 times that. So I don't have volumes memorized, but you can certainly look at the volumes and see if you're in a big day. We'll talk when we do paper 2 that the open, the close, the high, and the low are really important. So if your firm announces earnings, you might say the stock was up 3%, but it might have been up 7% at one time during the day, but it closed at only 3% up. So it might have shot up a bunch and then it came down at the end of the day. That's important to tell your boss that, yeah, the initial market reaction was huge. It ended up 3%, but it was up as much as 7%. That's pretty good information. So the opens, the highs, the lows, and close. We'll talk about this adjusted close. It doesn't mean much with the S&P. There's the ticker for the S&P. You actually have to type in that little hat, Shift 6 GSPC. That gives you the S&P 500. All right, the 10-year Treasury. Anybody want to try? What did it do today?
It moved 7.5 basis points.
7.5 basis points. All right, I'm going to type it exactly how I like to do it. There are other ways. There are more than one right way to say it. And there's a lot of wrong ways to say it. I don't think you don't have to do it exactly the way I say to say it. If you say it the way I say it in an interview, you'll be perfectly fine. If you say it the wrong way, you're probably going to be in trouble. So let me do the S&P first. Julian, you did it, or Julian, right?
Yes, sir.
Okay, you said it right, but let me put the entire sentence in there. Okay. Sometimes Bill Gates is helpful. Sometimes he's not helpful at all. Okay. S&P 500 was up 33 points. Today are 0.8%, closing at 4173. Oops. Or you can just say 4174. So you want to say that it was up, and you want to say points, not basis points, but points. and you want to say 0.8%. It is not wrong to say the S&P was up 80 basis points today. You can say that, and that would be correct. 0.8% is 80 basis points. If you do that interview, they're going to think you're showing off. That's overkill. You don't need to say up 80 basis points. It's up 0.8%. Why? Well, because this 4174 is not a percent. It's an index. So it's not confusing to say it's up 0.8%. There's no confusion there. That's the more normal way to say it. So you can say 80 basis points you want to show off, but they're going to think you're trying to show off, and it's actually going to be negative. So it's just say 0.8% and 33 points, not basis points. And you want to give the closing value because people somewhat know, especially right now, 4,000 is a really important number. So people are aware of that 4,000. If you fall below 4,000, above 4,000, people are really aware of that. So saying, hey, we're at 4174, say, okay, we dropped down well below 4,000, got down like 3,800 during the summer. Now we're back up to 4174. That's meaningful to a lot of people. Why didn't I say the S&P was down $33? It's an index, right? It's not really in dollars. If I was talking about oil prices, could I say oil prices were down $2? That would make sense because oil is in dollars. Okay, so look at what you're looking at. If you're looking at an index, you say points. There's a lot of dollars in there, but you can't actually go out and buy something for $40,173. That doesn't exist. There's no way to actually buy that. Now you can buy the SPY. The SPY is a mutual fund or ETF, exchange traded fund, based on the S&P 500. It usually trades at 1/10 of that. So you can go out and buy that for $417. So you could say that the SPY was down $3.29 today. That would make sense because it's in dollars. All right. So if it's in dollars, like gold or oil, you say it's down $3, down $4. If it's an index, you say it's down points. Okay. Now let's try the hardest one. So the 10-year treasury, I'm going to use a few more words than you did. Treasury yield was down 7.5 basis points to close at 3.03%. As bonds, did they sell off or did they rally? What did they do? Not interest rates fall. What do bond prices do? They rise. So they rallied. And they rallied after a couple of days of sell-offs. So anything happening today that might hit interest rates? You got the Fed making speeches. It's a pretty big day for bond markets. And the bond market rallied. So I don't know exactly what Jerome said today. He said something that made bond markets happy. Why do interest rates fall? They can fall if they're expecting a recession, things are going to slow down. So people are saying, hey, you know what? Economy is going to slow down. I'm going to lock in that yield from yesterday. Interest rates fall because people are worried. So bond yields can fall because they're worried about bad news. They can fall because inflation fears are going away. If people are less worried about inflation, you don't need as high of an interest rate to cover you for inflation. So it could be that. There's a whole lot of things that could go on. William was talking about there was a 7-year auction today on the treasuries, and that auction went really, really well. That supply and demand can certainly influence it. Not as much with the 10-year, but with the 30-year bond, supply and demand imbalances can cause yields to move around. But that's the way you would say it. So see what I said. So you see the word I added there. I'm a little pickier. What you said was correct, but I would say instead of, I think you said the 10-year treasury was down 7.5 basis points. I like to say the 10-year treasury yield was down. So with treasuries, I'm real clear if I'm talking about the yield or the price. Okay, so the yield was down, but the price was up. And I like to be real clear. So now you notice here, I didn't say how much the price was up. We don't ever say that with treasuries. I'll show you a website where they actually show you the price and they say the price was up $2, but we don't say that. And the reason for that is there is no 10-year treasury. The US government did not issue 10-year treasuries today. So what this is they went out and they found a 20-year treasury that was issued 10 years ago, and they're looking at that because it has 10 years left. And there may be 7 of those. There may be a 15-year treasury that was issued 5 years ago. There may be a 30-year treasury that was issued 20 years ago. So there's more than one 10-year treasury. So they're just finding one that's about 10 years away. In fact, when I was where you are, it's pretty crazy. We used to get the Wall Street Journal, and you went to the page that listed all the bonds. And that's how we figure out, we go find a bond that was maturing in about 10 years, and that's how we got our yield. I don't think any of that's in the Wall Street Journal anymore. Y'all know the Wall Street Journal used to list all the stocks, all the bonds, their yields, their maturities. There's just pages and pages. And that's how we got our data. There was no internet. We had electricity, but there was no internet. There was no place to go and get these prices. So now you can go to Yahoo Finance and get these numbers. So the bond market, now, is that a big day or a small day? What did I say was one standard deviation there? 6.5. So those are a pretty big day for the bond market. Pretty good rally. You see that less than a third of the time, something maybe that dramatically. So let's look historically at it. So you can see what's been going on with the S&P. We had that big day of 2% down, 2 really big days together, a big day up. Prior to this, early August, we had a really good rally in the stock market. We had several days, a good strong week. And then this week was a little bit of a shock. What is the market reacting to? You always have corporate earnings coming out, so they're reacting to earnings. Earnings have been fairly decent this earnings season, so it's probably not earnings. It's probably right now they're worried about recession. That's the big debate right now. Are we going to hit a recession or not? What's the Fed going to do? So markets are worried about that. So it's been fairly choppy, was really positive, got up to 4,300. Now we're back down to 4,172. So that's a pretty big drop in just a couple of weeks. On treasuries, these are basis points. So the day treasuries fell 7.5 or 8 basis points, you can see a really big day back there where rates rose 11. What's real key right here, you think? Do you think 3%? It's a psychological number in the bond markets. I had lunch with my good friend at Victory Capital. And I said, I'll have lunch with you next Tuesday, assuming the 10-year is above 3. And he come back and says, there's no way it's going to be above 3. And he was right. The market rallied and 10 years fell below 3. But since that time, it's come back up pretty dramatically. We got up to almost 3.5% earlier this year. I was extending duration. We'll talk about that. Y'all know what duration is? So I was extending duration. Every time when we hit 3, extended duration, we hit 3.25, we extended, when we hit 3.5, extended. Well, then we rallied back down to 3, even getting back down below 2.8. Since then, it's gotten back. If we hit 3.5%, I'm going to extend again. If we get to 3.75, if we get to 4, I'm going to be as full out on duration as I can go. So if treasuries go up to 7-8%, I'm going to be in a lot of trouble because I'm going to be locking in at a 4-year yield and a 10-year. We're talking to William and Kevin earlier about high yields. They're up to 8%, but they were down below 4% not too long ago. So bond markets have been moving a lot this year. So let's just look at the history, because I want to, I remember I said you got to know when to gasp. If any of y'all work for Zoom, you need to tell them they need to pick another button besides the escape button to take that away. All right, so the market, wow, what happened in the market? Man, something came out. Did Jerome Powell say something? Look at that. We ended up, now what kind of day we end up with?
A big day.
You may want to explain that one. Anybody want to take it?
We ended up for 1.41% up, like in percentage wise.
Okay, say the whole sentence. Someone give me the entire sentence.
Sorry, the S&P was up 1.141%. for the day, closing for the day, I'm sorry.
All right, give me all three pieces. You got the 1.14% right. Anybody else want to try? The entire sentence.
The S&P was up 58 to 35 points, for 1.4%, closing at 41.99.
That's the way I would. That's the way I would do it. I would put people in finance. They want to know how many points it was up, the percentage it was up, and what the closing price is. They want those three pieces of information. All right, I would work that into your sentence. Now on paper one, I have some students that this is the way they write. The S&P was up 58 points. The S&P closed up 1.41%. The S&P's closing price was 41.99. 3 sentences. It's like, give me a break. Put it all in one sentence. They do that on paper too. The firm announced earnings of $3. The market expected earnings of $2.80. The firm beat by 20 cents. It's like, why are you doing that? The firm announced earnings of $3 compared to the $2.8 expected, so they beat by 20 cents. Put it in one sentence. I have students that'll give me a paragraph that should just be one short sentence. So find a way to say it efficiently and practice saying it. So when you get into an interview, yeah, the market was up 58 points today, 1.4%. S&P's closing close to 4,200, still off of its high. You know, that's the kind of things they're looking for. So you can just rattle it off really fast. All right, it sounds like you are starting to get it. The tenure is the more difficult one. And if you download this, you can go back to even before my birth, the date of my birth. They go back. I was not alive here. I know it's hard to believe, but that they go back to 1962. And I don't know why they put the holidays in. This is the only data set where they put holidays in, and it's really irritating. So you have to go through and delete them out. But in fact, I'm going to do that real quickly because it is just irritating that they do that. Kevin was talking about how do you know when you know Excel good enough to get the job he has? And there's one way that they will know if they sit you down to do an Excel test for a job. There's one thing they're looking for. Anybody know what that is?
Are you typing your own formula?
Well, they want you to know the formulas. That's true. Don't use the mouse. Yeah, did I tell y'all that? You don't use the mouse. And I'm not in that my word. Look how many holidays there are. And I messed it up. Okay, let's do it this way. Why they put the holidays in there, I don't know whose logic that was to do that. Y'all know what the highest tenure treasurer ever was? At least in this period of time and probably forever, 15, almost 16%. I remember when I graduated from UT Austin, I had a CD and it was maturing. And so I'll go into the bank. I just want to get my money and say, well, we can roll it over at 15%. I was like, 15%, forget it. That's not a very good rate. Anybody want a FDIC insured 5-year CD paying 15%? Would any of y'all take that? But, all right, let's sort it again. So here's the gasping moments here. So I'm going to take the change and that I'm going to do it in basis points. So to do it in basis points, I said you multiply by 10,000 because a basis points is 1/10,000, but this is already multiplied by 100. So I'm just going to multiply it by 100. So the 10-year treasury fell 3 basis points. Y'all see that? It went from 4.06 to 4.03. That's 3 basis points. You better get good at basis points. And you can't sit there and do the math in your head. All right, someone tell me that one. What did it do? Real quick, 2 seconds. It's too late.
3 basis points.
Up 3 basis points. What'd it do? Drop 2 basis points. All right, good. So let's take the change in that. Oops, that's not what I want to do. Zoom. Let's see if the 6.5 is still good. Still pretty good. So the standard deviation of the change is 6.5. All right, so a 6.5 day is pretty big. So let's go back. So what about August 5th? You think Kevin and William noticed August 5th? 10-year up. What did it do? Up 16 basis points. Pretty big day. That's almost three standard deviation event. So let's go back to 2020, where we saw some stuff we'd never seen before in the history of markets. So look at the 6th. Treasury yields fell 22 basis points. And here's the all-time low. 10-year Treasury, 0.5%. Anybody want to buy a bond that's going to pay you 0.5% for the next 10 years? Does that sound like a good investment? When inflation's 1 or 2%, doesn't make sense. That's almost a 4 standard deviation or 3.5 standard deviation event. But we got one 2 days in a row, 3 days in a row. We got 3 sigma events. Your stats class said that's mathematically impossible. That could never happen. 3 massive days, another one right before. There's another 22-day. Look at that. 226, 27 basis points. That's a 4 sigma event. How often do you get a 4 sigma event? The wrong one. I always pick the wrong one, and I don't want to hit escape because that's going to come back. Well, it's pretty rare. You shouldn't see. You can maybe see one of those maybe every 5 years, every 10 years, one day. We saw 3 of them 3 days in a row, and you got 2 of them 2 days in a row. That's mathematically that should never happen. What we saw in 2020 was just off the charts. You should not. We saw the same thing in the stock market in 2008. We had 11 sigma events in 2008 in the stock market. You can go do an 11 sigma event, and Excel will tell you it's mathematically impossible. It cannot happen. If you live for 7 trillion years to the 7 trillionth power, you will never see that. And we saw 3 or 4 days like that in the same week in 2008 in the stock market. So these are big events. You can see the rest of the year got a little calmer, but that is a market that is a very volatile bond market. So obviously people are really worried. I actually shorted the treasury market on that day. When I saw the 10-year hit 50, I went out and shorted treasuries because I was like, I don't think they can go any lower. I was real lucky that I just hit that day. One of my former students in New York said, no, it's going to hit 25. It's going to go down further. So I think my chances 50 seems pretty low to me. So I bought a short treasury fund. But yeah, just crazy, crazy, crazy. But keep that 6.5 in mind. If you were to bring this up in an interview, let's say you're interviewing on that day. Just imagine walking in and saying, yeah, the 10-year treasury is up over 16 basis points. Boy, that's like almost a 3 sigma event. You just beat the competition. This isn't like UT versus Alabama. This is like Alabama playing Monroe or whatever, this is like 80 to nothing kind of victory. You just smash the competition. But you can't do that unless you start practicing. The next time you think about this as an interview, you're going to say it all wrong and it's going to sound bad. So what did the 10-year treasury do on this day? Did the bond price go up or did it come down? Down. You would use the word what? Sell off. You say, hey man, you see the sell off in 10-year treasuries? Now I can give you even a better way of saying it. You can say up 16 basis points. But that doesn't sound like you work on Wall Street. So how can you say it better? We shorten it to BPS and we actually say bips. You see the 10-year treasury is up 16 bips. Right? I told y'all about that, didn't I? You gotta use the jargon. So you sound like you've actually been working in the industry. So now where I work, they didn't even use the word bips. So they just came over and said 16 over, 12 over, 50 over. They didn't use the word bips. They just knew they were talking basis points. But all right, so that's what you got to get. So you get comfortable with talking about these markets. So on paper one, hopefully we'll have a day like this, not a day like, well, today was a pretty decent, yesterday was a pretty decent day, 5 bips. So you want to say it correctly, using the right jargon, and then making sure you give all the pieces. So on the S&P, we say the points change, the percentage change, and the closing. On the 10-year treasury, give the basis points change, whether the price went up or down, and the ending yield. We don't give the dollar change in the price. We just say whether the price went up or down. We usually use words like rally or sell off, or flat, a flat market today, or treasuries are up slightly today as the yield fell 2 basis points, something like that. All right. Any questions on this? I might test y'all again on Tuesday just to make sure you're getting comfortable with it. Did y'all already know this? I've noticed previous classes, like I've never seen this for my life. But, and I think that's probably true of most undergraduate students, but when you interview, they do assume you know all of this because it's just second nature. So get used to this. Another thing you really need to do, if you don't have a brokerage account, get a brokerage account and start trading with paper money. You don't have to use your own money. Start trading. So a lot of the students here like Thinkorswim. I don't know if y'all use Ameritrade, but Thinkorswim, you can just go to thinkorswim.com. I've never done it, but I use Schwab. Schwab's a great company as well. I really love Schwab. I don't know if Schwab allows you to have paper portfolios or not. I don't know if any of y'all know, but Thinkorswim will let you set up a paper portfolio and just start trading. You don't want to interview for a job like the job Kevin has, and you've never traded a stock in your life. That's just not going to sound good. And they'll buy the paper trades. Now the investment society, we have what we call the market watch game, where you actually go in and compete against everybody else and you do your own trades. That's a good way to practice. I don't really care who wins because it's over 3 months and it's pure luck who wins. In fact, the smartest thing to do in that competition is to do what you would never do in real life. And that is to find the most volatile thing you can find, because you're either going to go and be in last place or in first place. And that's the way you play the game. If you're in last place, no one knows because you're so far down, they don't see your name. So you're either going to be first place or last place. It doesn't, and then you win, $100 or whatever the game is. So you put all your money on GameStop put options or something. All right. So if you're a finance major, start thinking in terms of finance major. If you're an accounting major, still do it, because there's nothing more impressive than to be able to talk somebody else's discipline. That's really, really impressive. I think what has really impressed me in the executive MBA is they have a deal now with the UTSA Health Science. So I have all these doctors, and my word, they're good at finance. It's kind of embarrassing how good they are at finance. I know that's not their reputation. We think of doctors as being these arrogant people that don't know anything about markets, but they think they do. But these doctors were really, really good. I was very impressed how they could pick up the jargon and express it. Okay, we'll practice more on that. Okay, so let's start in exam 1, question 1 is a massive question. I do allow it to be the first question. I do allow open notes, so you'll actually submit it. It's almost like a paper you have to write, but you can't plagiarize. You have to use your own words. So before we look at this, let's step back. Let me give you the 40,000 looks so you can see where we're going. So the question is, what's an investment portfolio and what do you need to do to set one up? What's the important criteria? What questions do you ask? The way you get it in an interview, which is those students that got that question right before they're taking this exam, the way you get it in an interview is to say, hey, assume someone just gave me $500,000. What would you recommend I do? It's essentially that question. And they just rattle off the answer to this exam question. So we're going to start off with an investment portfolio. You got some money you want to do something with, right? So we're going to start off with what is an investment portfolio? And then we're going to get into some questions. There's 3 questions to ask. Why are you investing? What, which is in what can you invest? And how, and that's the execution. We're going to focus the first part of this class really on the what more than anything else. We'll talk about the why. We'll talk a little bit about the how, and then we'll really get into the how the second half of the class. But why are you investing? In what can you invest? Can you buy stocks? Can you buy bonds? Can you buy classic cars? Can you buy coins? Can you buy real estate? Can you invest in a hedge fund? In what are you allowed to invest in? And then once you figure out, hey, I'm investing for this. These are the things I can buy. This is what I want to buy. Now I'm ready to execute. How are you going to do that? Okay. So that's the nuts and bolts of the question. We're going to spend most of our time here on the what. And on the what, we're going to talk about asset classes. You even heard that term, asset classes. We categorize assets into different groups. And so you know some of these. Cash, what is cash? Do any of y'all have cash? Is cash only bills in your wallet? Does cash include your savings account, your checking account? Might even include your credit card. You're told to have an emergency fund for about 6 months. It's perfectly acceptable to have a credit card that has no balance on it and be an emergency fund. That can help tie you over. So cash is very liquid. You can use really fast. Bonds, that's what William and Kevin were talking about. They're investing in bonds. William took John Tui's class, which I highly recommend. He teaches a bond class or fixed income class. William took that class that helped him tremendously in the job at Victory Capital. Victory Capital does stocks, but the one here in town is mainly the bond people because that's what they took from UTSA. But bonds, also known as fixed income. Stocks, also known as equities. I don't like using the term equity for stocks because I think it's confusing. My job at UTSA when I retired was VP of equities. So they actually had the word equities in my title. I don't like equities. Equities just means you own something. So if you invest in real estate, guess what you have? You have an equity position in real estate. So equities is stocks, real estate, classic cars, anything you have an ownership in. So I don't like the word equities. I just like the word stocks. And then we're going to talk about everything else. We're going to call them alternatives. So what we're going to be spending a lot of time the next few weeks is breaking down each one of these. We won't spend much time on cash, but we're going to spend a lot of time on fixed income. And I'm going to give you one of my mnemonics. I'm going to make t-shirts out of this one of these days. It's called DC Cuts I. I didn't ask Kevin for DC Cuts I. He was trying to give it to me earlier. And it was pretty hilarious because he forgot the second C. And the second C is credit. And guess what Kevin does for a living? He does credit. It's like, Kevin, the second C, how could you forget the second C? Oh, credit, right. That's my job now. So I'll explain what DC Cuts I's is. On stocks, I use what is called bucks. You notice they both have a U, and the U is the same, but the U is very different for bonds. So the U is US versus non-US. It's international stocks, international bonds, but very different between stocks and bonds. And then alternatives, we'll talk about alternatives. So we're going to get in this in detail. What you've got to do on the exam is flesh this thing out just like we're doing it. So we're going to start, I'm giving the high level first so you can have something to kind of wrap all this around. but we're gonna get into this. The D, duration for bonds, extremely important. These two guys talk a lot about it. And duration, probably William more than Kevin. Duration is far more important for investment grade bonds than it is for high yield bonds. In fact, I was quizzing Kevin. He was talking about yield the worst. I was thinking yield the worst for high yield. We'll talk about yield the worst, but that's like, I didn't think high yield even thought they'd make it the worst. They'd go bankrupt even before then. Why do you use, he said, yeah, we don't really use yield the worst. So he kind of surprised me when he brought it up. Convexity, extremely important number. We're going to talk about that. We're not going to actually calculate it. We're going to talk about how to use it. Very, very important. For William and what he was doing, probably doing mortgage-backed securities, convexity was a big issue. Credit, you heard a lot of credit today with high yield. High yield is that junk, low quality bonds. They have high yield. Why? Because they're low quality. We'll talk about that. We'll talk about non-US taxes, structure, and inflation. So we're going to get into those, each one of those. I keep asking, like I had these two guys, I said, what else can I add to my list? And I haven't found anyone that can add anything else to the list. You'll discover this S looks like one little letter there, and we're not going to talk much about it. But if you get the handbook on fixed income, the famous handbook by Fabozzi, almost half his book is on the S. It's on structured debts. So that's a huge one. That's what William's trying to decide. He did some commercial mortgage-backed securities. He's going to decide maybe he specializes in that. That would be a great career. That's a structured debt, very specialized. So we're going to, on some of these, we're going to go through them really quickly. But in practice, they're massive. They're an entire career. Not the S, I'm talking subcategories of the S can be your entire career. So you can really get into this stuff. So we're going to flesh all of this out. On the why, most people, when they think the why, they think retirement. That's a pretty common one, isn't it? So remember in this class, I wanted comprehension, retention, and application. See if you can do that. So find, y'all all got that weird uncle, don't you? The weird uncle. He's got a lot of money. You don't know how because he's so weird. Somehow he kind of walked in all this money. Call him up and say, hey, I'm taking this investment class, and just walk him through this. Hey, Uncle Todd, what's the duration of your bond portfolio? What is Uncle Todd going to say? If he works on Wall Street, he'll give you a really good answer. If he's a New York cab driver, you may not know what that is. Although I've had some New York cab drivers explaining to me how stocks work. I always like my Uber driver, when I was on vacation for 2 weeks, I had no access to internet. He gave me all the update on the Federal Reserve and everything. So I say, hey, good. So walk through this. I'm not saying manage his money because that'd be kind of dangerous. You probably want a little more experience, but practice it. Start getting this. One of the best ways you can get this to go to your permanent memory is to talk about it, get involved, ask questions. The best way is to debate. So get into debate with someone on this, and then it really sticks with your long-term memory. So, but ask your uncle, what are you investing for? Are you investing for retirement, or you're investing so you have something to leave me when you die? Why are you investing? That why, and we'll get into that. In my risk management class, we talk a lot about that. We do talk about my career, which is balance sheet immunization. You tell me why you're investing. That raises a bunch of lists, a long list of risk. I want to make sure my assets address those risks. So retirement, what are your risks of retirement? What are you worried about with retirement? Are you worried about living too long? That doesn't sound like something, but if you assume you're going to live to 90 and you lived 105, you've got a problem, don't you? Those last 15 years, all you got is Social Security. That doesn't sound good. So longevity risk is a big one. Inflation's a big issue, isn't it? You retired last year, assuming inflation at 3%, and now you're like, okay, this isn't good. I'm going to have to either go back to work or cut back on my expenses. So you figure out what those risks are, and then you make sure you have assets. Is there an asset that will do well if inflation takes off? So we'll talk about that when we talk about the I. Is there a bond that will do well? Are there bonds that include inflation in their returns? Yeah, there are. So do you want to put all your money into those bonds? Probably not, because they're extremely expensive right now. But I'm very much in this camp of an investor. Tell me why you're investing, and I'll find assets that address that investment. So if you have specific risk, like inflation, then I might want to put some money in commodities and real estate, those type of assets that tend to do well if inflation takes off. What about longevity? Is there an asset that does extremely well if you live too long? And absolutely there is. Life insurance industry sells annuities. When does annuity stop paying you? When you die. In fact, I got a product I've been pushing. I tried to get it patented when I was at UTSA and I couldn't get them to do it. Very frustrated. My life insurance class, aren't you in that? Yeah, we're going to talk about that product later. So Derek can tell you all about it. And Luke too, right? Or both, because I see your two names right there. You're alphabetically, it's like Derek and Luke. That's how I've learned your names. They're going to hear about that product. It's a product I love, but I can't get anybody to sell it. So I'm hoping maybe one of them will start a life insurance company and we'll sell it. But it's a product that if you live to 90, it gives you $5 million. If you die at 89, it gives you nothing. But if you make it to 90, it gives you $5 million. That sounds pretty good. How much does it cost you? It might cost you like $20 a month. Does that sound like a good product? Before, your family's like, well, you die already. We want your assets. Now, what are they doing at 89? It's like, come on, you can make it one more month. Now they're like propping you up. Weekend at Bernie's or whatever they're just like, we're going to keep this guy alive. It's a very different mentality, but there are assets out there that will pay off handsomely if you live too long. That's what I loved my career is tell me about the liability and I'll go figure out the assets. You can see why I retired in 09 because I was managing mutual funds. What's a mutual fund? It's nothing but assets. I don't know anything about the liability. I was like fish out of water. It's like, I can't deal with this. I didn't find it fun at all. It wasn't my thing. William's working with mutual funds. He likes that, but that's not my thing. I want to know why are you investing? What are those risks? And I'm going to find you assets to handle that. We're going to spend most of our time here breaking this up so you can understand what durations did your uncle have, what convexity should he have, what credit risk should he look at, what's his tax situation, should he buy municipals? William mentioned municipals. We're going to get into all that. What should his beta be? Should he be doing growth stocks or value stocks? I shifted to value stocks early this year. Really glad I did that because what happened? Growth stocks sold off. I finally got one right, so that was good. But my mom in the value stocks because I could see that coming. So we'll talk about that. And alternatives, all kinds of alternatives. And then on how, we'll spend some time there. So this is the outline of that question, but there's going to be a lot of details in there. How much details should you put? Everything you know. Go overboard. I might show you the best answer from last semester. I'm scared to do it because it might scare you to death. I think 2 semesters ago, one student, do y'all want me to show you his paper? It might freak you out. Because he said, that's great, Professor Sweet. I heard everything you said. Oh, by the way, I went out and read every Wikipedia article on this, and I learned a million other things as well. And he put all that in there as well. It's like, I said, why'd you do that? You had an A+ even pre to this. I said, well, I'm not going to college to get grades. I want to learn this stuff because I want to make a lot of money. So he wanted to learn it. So he just went out and taught himself. It's a kind of an incredible concept, isn't it? My best students, that's what they do. Half of what they learn in class. Half of what they learn, they teach themselves out of the class. And then when they interview for jobs, they know twice as much as everybody else. Pretty cool concept, and it works tremendously. So there are things you can do that go beyond this. We're going to scratch the surface on convexity. If you want to go out and learn more about convexity, guess what you do? You just type convexity, Wikipedia. No, convexity, convex. I'm going to put, come on. Put bonds in there. That'll probably help. Bond convexity. There we go. Bond convexity. I'm not going to donate you any money. Calculation of convexity. There it is. Then they start talking about things like modified convexity or modified duration, effective convexity, effective duration. The math gets really, really messy. This is very, very difficult stuff. But I mean, think about Kevin. It's the hard stuff that they pay you a lot of money for. So if you get on the bond side, I think this is why William is so interested in bonds, because there's a lot more math. He can learn this stuff and learn it really, really well. One of my favorite bond portfolio managers, a lady named Dee Dee, she ran USA's income fund, which is their largest mutual fund. She had a PhD in math. And I love talking to her. Boy, she called 2008 perfectly. She said, I'm seeing stuff that shouldn't be out there. This market's about to tank. I wish we had listened to her and just shorted everything. But she had it perfectly. I remember leading that meeting going, okay, Dee Dee's one of the smartest people I know. If she's right, we're not in the right place in the market. We need to radically change. But she had a PhD. So you think, while she's running a bond mutual fund, she's got a finance degree. No, she had a PhD in mathematics. So if you like math, you like quant, fixed income is a really good place to go. So you can see Wikipedia does a pretty good job of this. And you notice the Black-Scholes formula in there. There's a lot of optionality, option theory in fixed income. And so I remember when I took part 2 of the CFA exam, they asked a Ginnie Mae question. We're going to talk about Ginnie Mae. Ginnie Mae's are option bonds. I had the Black-Scholes formula memorized. I just stuck it on the exam. I thought they'd be really impressed. I actually knew the formula and could put that down on the exam. So we'll talk about convexity. You're not going to understand convexity in this class do much with it other than just know conceptually what it is. What I'm trying to do is show you there's a lot more out there. And you get paid in finance for specializing. And you got to find that specialization fairly early. I know William has. He's pretty much decided. You can see Kevin's still kind of, I might switch this, and might do this, which is fine. Kevin's a really smart guy, so he can handle that switching around. But at some point, he's going to have to find a place where he goes many, many miles deep, because that's how you do it. So for me, it was balance sheet immunization, working with actuaries. That was my thing. I have some students, they want me to help them find that while they're in college. Can you guess my senior year in college, what my thought on balance sheet immunization was? Anyone want to guess? I'd never heard of it in my life. And it became, so you can't plan out your career. What you do is you find the most complicated thing you can stomach and you stick with it and you learn it as far as you can go. So bonds have that ability to let you do that because there is a complexity there. All right, so this is where we're going. So let's start off just real quickly with the first definition, and this is where we'll start on Tuesday. What is an investment portfolio? I do count it for plagiarism. I don't know how you word this much differently. So this one, don't go wild and, get a thesaurus out and find a different word for of and a, you can use some of these words, but it's pretty simple. An investment portfolio is a collection of assets held for some future purpose. And if you need an idea, just think retirement. That's the most common one. Collection of assets. You notice I didn't say a collection of securities. So there's a difference between securities and assets. All securities are assets, but not all assets are securities. So Kevin was talking to me that they're doing some direct placements. Well, direct placements is that's when they're loaning money. A lender and a borrower, they come together. The SEC, the regulators are completely out of it. A very wealthy, large investor finds a borrower and they just have a deal together. That's called a private placement. It's not a security. You don't trade it. It's just a buyer and a seller get together and they're put together by Kevin's department. Kevin finds someone who wants to loan money. He finds someone who's trying to borrow money. He brings them together and they do direct placement, keeps the regs out of it. That's an asset, not a security. But a stock is a security. You can trade it on the exchange. Treasuries are securities. Real estate, what is that? Is that a security or is that an asset? That's an asset. A stock is a security and an asset. And this, to me, is the key for some future purpose. I remember I went to a party once and there was a bunch of USAers there and a guy named Paul. I worked with him a lot. Hey, Ron, good to see you again. I haven't seen you in years. And he introduces his wife to me and she says, hey, should I buy gold? first question to me. It's like, well, why are you buying the gold? For what purpose? You're gonna buy, TV tomorrow and you want to invest in something today? No. Are you buying for your retirement? So I can't answer that question. Tell me why you're investing, and then I can tell you whether you should buy gold or not. So that's where we're going. That's what an investment portfolio is. Now we're going to talk about how to build it. Why are you investing, and what can you invest, and how are we going to actually implement this? All right. What questions do you have at this point? We haven't really started yet. We got questions?
You talk about, how, when the next investment society or when it starts?
I'll let you know. I think September 7th is the first meeting. That's all you need to worry about now. So they're going to be Wednesday nights at 7:45 in one of the big classrooms on in the main hallway, the second floor. But I'll tell you specifically, I send out an email every Friday. I haven't gotten a complaint from any student yet that they hate that. So I'm going to email you every Friday what we did this week, what you need to do for next week, any announcements about student organizations, those kind of things.